FINCA, over that last 40 years, has taken $500 million in donations and grants and translated that into $16 billion worth of loans.
The inclusive finance industry needs to lean into climate risk rather than run away from it, because ultimately there's nowhere to run. We have to figure this out. We need better answers to the challenges that climate change poses.
Welcome to Financial Inclusion Unlocked, the podcast featuring conversations with innovators, practitioners, and thought leaders who are working to unlock the potential of financial inclusion. This podcast is produced by SIJ Media and hosted by me, Jack Farron. Thanks to our Series 2 sponsor, CGAP, the innovation lab for inclusive finance that works to advance the lives of people living in poverty, especially women, through financial inclusion. Climate shocks are intensifying, and inclusive financial institutions face a dual challenge: protecting portfolio quality while supporting clients through recovery and long-term adaptation. Grounded in local stories and global evidence, including a focus on how microfinance institutions were affected after severe flooding in Pakistan, for today's episode I travelled to meet Peter Zetterli, the Green Lead at CGAP, and Andrée Simon, Global CEO at FINCA International, as we explored practical institutional level approaches that help MFIs and inclusive banks remain viable, protect their social mission, and channel climate adaptation finance to local communities. This is a fascinating and timely conversation with two global leaders in the space, and I hope you enjoy it as much as I did. Andrée, Peter, welcome to Financial Inclusion Unlocked. Really great to have you here in a snowy morning in DC. Thanks for being here.
Thanks for having us.
Thanks, Jack.
Before we get into the conversation, I want to learn more about both of you and why you started in this work. Peter, maybe you first.
Yeah, so I work for CGAP, which is a think tank housed in the World Bank focused on financial inclusion. I've been there for about 15 years now, based in Africa, much of that time working on mobile money and digital financial services. I led our work on fintech for a few years, and the last 4 years I've been leading our work on climate change. I first started working on financial inclusion or microfinance just before the year of microcredit in 2005-06. Those were the heydays of microfinance. I was working for the UN in China on various socioeconomic development projects, and one of them was the microfinance project that the UNDP had been running already for 15 years. And this was the time when the industry was moving toward commercialization, more commercial and scalable approaches, making the case that there was a positive business case and an investment case in attracting more impact capital and even commercial capital into the space. And one aspect that I found so compelling about working in this intersection between public policy priorities around poverty reduction and development and the commercial modalities for deploying solutions in service of those objectives was just the dynamism and the scale that you could start to achieve things at. It became clear that by tapping into positive business cases, you can just achieve things at a 10, 20, 50 times greater scale than you can with development funding by itself. And that is one aspect of what is so compelling about working with these kinds of models.
It's great to have you on the show, Peter. And Andrée, please introduce yourself to the audience, and how did you get into the world of microfinance?
So my name is Andrée Simon. I'm the CEO of FINCA. FINCA is an organization that's existed for about 40 years. We started from the premise that people are perfectly capable of earning income and improving their quality of life, but that they need access to capital. You know, it's kind of an emotional question that you're asking, actually. So at the risk of revealing a lot about my family history, my father was a war orphan in France. His mother was alive, but his father was killed. And so he and his two brothers really depended on their mother to provide for them. She worked in an embroidery factory. I think it was not very nice conditions. And my mom grew up in the Midwest, and also had to fight some pretty challenging conditions. They were both born in 1940, so it was immediately post-Depression. And so they kind of instilled in me from a very early age, that, you know, you have to work really hard to create opportunity for yourself, and that everyone is capable, and that some people just happen to be luckier than others. And so that's always been at the foundation of my mindset, that everyone deserves a shot and is capable of taking advantage of that shot and adding something positive back to the world. And then I think very much more concretely in terms of my fall into microfinance's arms. I was working in financial services, and it was not the most motivating work in the entire world, even though it was intellectually fantastic. And I ran into a very close friend of mine, who is still a friend today, who started talking to me about the work that FINCA was doing. And like many people who get into microfinance, I saw the skies part, and I said, oh, it's possible to use financial services to actually do a lot of good in the world. And so for the last 20 years, that's what I've been doing. And so FINCA, over that last 40 years, has taken $500 million in donations and grants and translated that into $16 billion worth of loans. Obviously, our goal is to help people to improve their quality of life. The fantastic thing is that 9 out of 10 of our clients say that they have actually been able to improve their quality of life thanks to working with FINCA. A significant number of them say that they've been able to specifically improve access to education and improvements in health. Our focus is on productive credit. So around 70% of our customers are self-employed. That's a really important point that a lot of people don't quite understand, because we think about self-employment in the context of the United States or the West, but really we're talking about people who are self-employed out of necessity, meaning that there's no other opportunity for them to actually earn income. And right now, 85% of our customers say that the loan that they've received from FINCA is the first time that they've actually been able to work with a bank.
I really appreciate you taking the time to share that story. And thanks to both for actually dedicating your time and efforts to making financial services more accessible and useful for low-income populations. So let's get into the show. Peter, you mentioned that the conversation today would be focused on climate. I was reading an article that you co-authored for CGAP recently from the World Bank's Global Findex data from 2025. Tell me a little bit more about that in terms of the link between financial inclusion or exclusion and climate.
Well, the Findex survey tells us a lot about who is most vulnerable and most exposed to climate risk. I think there's an assumption among many working in the climate field and elsewhere that low-income people are more vulnerable and are in harm's way to a greater extent than others. And the Findex shows very clearly that is indeed the case. What it shows is that across low-income countries, a full 1 in 3 adults suffered a climate shock in the last 3 years, personally suffered a climate shock in the last 3 years. Just a staggering number, 1 in 3 people. And that's 50% higher in low-income countries than it is in middle-income countries. So you can see how the distribution kind of skews against low-income countries. Same goes for the vulnerability. So those 1/3 of people in low-income countries who were hit by climate shocks in the last 3 years, 2/3 of them say they lost income as a result of that. Nearly 3/4 say they lost assets or suffered damage to assets as a result of that. And you can appreciate just the enormous impact that has on their livelihood, losing income and assets as a result of that climate shock. Those numbers are 50% higher in low-income countries than in lower middle-income countries, and twice as high as they are in upper middle-income countries. So on both exposure and vulnerability to climate change, it skews very clearly. And the same goes within countries as across countries. People at the bottom of the income distribution within low-income countries and middle-income countries, more likely to be hit by climate change, more likely to lose income and assets as a result. People who live in rural areas, same thing. So it's very clear that the brunt of climate change is being borne by low-income communities. And of course, that has implications for the financial institutions that serve those communities.
I think that goes to really understanding the nature or the profile of the customer that we're talking about in many ways, right? So, the vast majority of the world's poor, these self-employed people that we were talking about, they are working in rural areas. They're working in agriculture. It's very small scale agriculture. And the reason that they're borrowing these small amounts to invest in their businesses is because they don't have any capital. They don't have any savings, or they have very, very small amounts of savings. So it's not really that surprising that when there is some kind of shock that occurs that is particularly a climate related shock, they're the ones that are going to be hit first, right? So it's disproportionately women. It's disproportionately the people who are the most marginalized.
Those stats are quite terrifying. And I know as FINCA, you're working in many of those markets.
Yeah.
So what are you seeing on the ground from country offices and colleagues?
Well, I'll say, first of all, honestly, this isn't new. FINCA has been dealing with droughts, earthquakes, floods for the entire time that we've been working, because we specifically focus on those places where people are the most financially marginalized. And so as a consequence, those are the people that get wiped out whenever any of those things occur. But certainly what we have noticed is that the prevalence of those types of events has increased. And at the same time, not a lot has really materially changed about how we mitigate that risk. And I'm talking about how those individual farmers mitigate that risk. We haven't seen, unfortunately, and we are seeing some, but we haven't seen enough progress with respect to climate insurance or crop insurance that really helps to protect customers. And there are some more structural issues that really need to be resolved in order for us to make the larger scale investments that can help to mitigate some of that.
Peter, in a part of your research, you mentioned 3 in 4 people that suffer climate shock actually have access to a bank account. So Andrée just mentioned there about the profile and characteristics of some of the customers that FINCA serves. You said it would be a tremendous untapped market opportunity. What do you mean by that? And Andrée, do you agree?
Well, so that's looking at things partly from the perspective of the climate finance community and the climate finance sector, which we've been engaging with increasingly over the last few years, because the reality of the matter is that the inclusive finance space and the climate finance space does not talk to each other. They don't know each other. They don't interact, which is absolutely crazy when you step back and look at it. And one reason I say that goes back to your question, which is to say, when we look at the climate finance conversation today, we already heard about the extent of impact on the ground at the personal, individual, and household level on low-income folks in low-income countries. When you ask the question, how much adaptation and resilience finance is coming from the climate finance sector to those communities, the first answer is we don't know, because no one's tracking it, which I think tells you everything you need to know right there. But if you piece together the data you do have, around 3% of climate finance goes toward adaptation specifically. The vast majority of climate finance still is focused on mitigation, so decarbonization, not adaptation, meaning helping people and communities actually live with the consequences of climate change that we already have produced. So just over 3% of all climate finance goes for adaptation. Of that, less than a fifth has a focus on low-income communities, whatever that means, right? But this is UNEP research that points to this. Put those numbers together, the conclusion is less than 1% of climate finance globally is going for adaptation with a focus on local communities specifically. And that does not mean that even that small portion of climate finance actually gets into the hands of climate exposed households and individuals who are the ones who need to do the adapting. Yep. That true number is going to be some subset of that 0.2% of climate finance that has that focus. So there's an enormous structural problem in climate finance around making adaptation and resilience finance reach the ground and get into the hands of the grassroots populations who actually need it. Because the system was never really set up to do that. In the first place, the current climate finance architecture was not designed to do that. So there's a big challenge there. And what's so striking when you look at that from an inclusive finance point of view is that the inclusive finance sector is the answer to a large extent to that problem of access to finance and distribution. So we need to connect these pipes. There's an inclusive finance shaped hole in the climate finance architecture, and we need to connect these two, because these institutions like FINCA and others are already in those communities. They're already serving them. They have long-standing client relationships. They have the distribution networks, everything. They have the knowledge about how to serve those clients meaningfully with financial services. And so that therein lies the opportunity for the climate finance agenda to finally reach the most vulnerable with meaningful access to climate finance.
So I think that's an excellent point. And I guess I might almost try and flip the envelope around a little bit to say, so Peter said there's an enormous business opportunity. But when you think out further on the likely impacts of climate on financial services, and let's just say global economic resilience, we have to recognize that it maybe isn't so much about creating positive economic benefit as it is about mitigating the risk that's going to really impact that. And looking at the communities that we serve, obviously, the umbrella that everyone looks at is poverty. But when you think about it, food security, migration, health, all of those things are intertwined with economic well-being. And so the opportunity is that, as Peter said, you have millions of smallhold farmers. If we can help to improve their ability to generate food in a reliable way, if we can help those communities to not only survive, but to become more resilient, we're actually then adding a net economic benefit to that future state.
We'll get into some of the positive initiatives that you've been seeing in the sector. And I want to dive into one example of Pakistan as a country that we can talk about. Peter, I know your team at CGAP has been working with the Pakistan Microfinance Network on a study which I encourage all of our listeners to read. It was quite fascinating, and one stat I think really stood out to me was that as part of the study and what you saw, 40% of MFIs were pulling back or reducing lending in climate affected sectors. Why did you start that study, and what were some of the key findings?
Yeah, so one of our concerns in this context is that climate change and climate risk is making it more difficult for financial institutions to serve low-income communities for all the reasons that we just discussed. Because inclusive finance is inherently about serving clients who are risky and costly and difficult to serve, as Andrée already spoke about at length. And the risk is that as climate change makes those clients more risky, more costly, more difficult to serve, financial institutions will see growing risk in their portfolio. They will face growing risk pressure from their investors and the regulators to manage that risk. And the easy way to manage that risk is to stop serving clients who are exposed to climate risk. And that's an outcome we don't want, right? And so that is obvious analytically. That will happen. We have also heard plenty about it anecdotally when we talk to financial institutions, microfinance institutions in particular, around the world, that this is already happening. But we wanted to start to get a more quantitative sense of the scale of this problem. And so we worked with the Pakistan Microfinance Network to survey their members, all the big MFIs in Pakistan, and ask them the simple question: in the last 10 years, have you pulled back from climate change? Have you stopped or reduced lending in certain geographies, certain value chains as a result of climate risk? And as you said, 47% of them said that they had reduced lending in certain geographies. 40% said they had reduced lending in certain value chains. 20%, 1 in 5 MFIs said they had stopped lending entirely in major geographies due to climate risk over the last 10 years. So those are some very, very sobering results. And it tells us a lot about the extent to which climate change is undermining the progress we have made on financial inclusion over the 10 years, which should be a wake-up call for a lot of us.
Indeed. And to bring the FINCA example into the conversation, because I know that you did have long-standing operations in the country.
We did.
What have you seen over the last few years?
FINCA started in Pakistan in 2014. We had a lot of partners that were encouraging us to get into the market, and we were very excited about it, actually. We grew the institution there into a very strong, well-performing institution. And at one point, it even generated a 27% return on equity. We were one of the first MFIs in Pakistan to issue a digital wallet. So it was really very much at the forefront. And then, of course, COVID hit. And I do think that in the same breath that we're talking about climate, we actually just need to talk about sort of emergency funding in general. And this is another piece of research that you've done that I think is fantastic. But really, the challenge with COVID, of course, was that globally, all lenders sort of were frozen. Globally, FINCA restructured over 50% of its loan portfolio to try and extend the grace that our clients had to be able to repay us. But that depleted our capital reserves really significantly. And then, of course, immediately following on that, we had the climate crisis. 3 out of 4 of the crop cycles in Pakistan failed.
This was in 2021 and 2022.
2022, yeah. And that was really just, there was nothing else that we could do at that point. And so we had no choice but to leave the country. And that was not exclusive to us. There were, as Peter rightly said, like a large number of institutions that were dealing with, portfolio performance that was just not sustainable. So I think that gets back to this question of, okay, well, what do you do when this is in fact a global crisis. And I certainly think that there are a lot of really smart people, including Peter, who are working on coming up with solutions, and the regulators included. But there's this challenge of, ideally, when there's a crisis, particularly if you know that it's a time-bound crisis, you would actually lend into that crisis. Right. So our customers have an extraordinary track record. They actually want to repay. The desire to repay is very strong, but it is literally that they don't have the cash flow in order to be able to do that. And so it begs the question of, well, can you extend additional credit that's going to allow them to get through that time-bound crisis in order to recover? Of course, that money has to come from somewhere. And I think that's, one of the biggest challenges is, as we're looking at climate crises, is there a way for us to designate funding? You mentioned earlier the World Bank Fund as a resilience and access that is designated to help support in climate crises. Can we come up with more funding that is actually going to backstop additional cash flow into the system? And if that's not the case, then yeah, you have no choice as an institution but to say, we're going to curtail our lending into these spaces until such time as we've been able to work with our customers to educate them about alternative crops, alternative irrigation practices, all kinds of different longer term initiatives that you would have to put in place.
You mentioned about some of those funding mechanisms, such as the World Bank's RAM project.
Yeah.
If that was something that was in place in 2022 in Pakistan that FINCA could access, would it have been a different story?
I think so. Yes.
Yeah.
That's the short answer.
It's sad to hear, right? When institutions have to pull back because they deem the lending to the clients too risky. I do a lot of work in climate insurance as well, and certain geographies are rapidly becoming uninsurable as well. So what can we do as a sector? I guess that's a question that's it's very tough to answer, but
well, I think there's the sort of system level where you can have additional funds like the RAM fund and others where lenders and funders in particular can put money aside for specific segments that they think need that additional support. And I don't want to confuse that with guarantee mechanisms. I think it really is about, having a pool of capital that you can call on in the event of some kind of crisis. That's a kind of insurance in a way. But then, of course, there is just regular insurance, customer level insurance and institutional level insurance that I think we need to make significant progress on. And then the last piece, which I mentioned previously, is that longer term. How do you actually change the structure of the risk? And there, I think we do need significant technical assistance. And it has to be a technical assistance that bridges from the institution to the customer and to the local government, right? Because a lot of these solutions that we're talking about implementing that help to really mitigate that risk and change it are not at the individual level. You can't put an irrigation system in at the individual level. You have to do it at the community level. And so that triangulation really needs to take place. And there are a couple of institutions that are looking at things like that. FSD is one of them that I know about. Microsave is another where we're really thinking about, how do you lean into locally led adaptation? I'll just say that none of those solutions is cheap or simple.
And I guess where the money comes for that technical assistance as well.
Yeah.
Similar to the funding mechanisms.
Yeah.
Peter, same question to you.
I agree with everything that Andrée has said. And I think our simple answer to the question, what needs to happen, is that the inclusive finance industry needs to lean into the climate change, lean into climate risk rather than run away from it, because ultimately there's nowhere to run. We have to figure this out. We need better answers to the questions that climate change poses and the challenges that climate change poses. What does that mean? Well, that means financial institutions need to act differently at many different levels. So at the level of strategy, in many countries, it is well past due that inclusive finance institutions bake climate change into the heart of their strategy. This is not a CSR issue. It is not something you do to look good for the investors. It's not some green finance business that you have running off over the side. This is table stakes increasingly for the industry. So we need the strategies to reflect that. We need climate risk assessments that do a better job answering the questions that the financial institutions have. So we see financial institutions, including inclusive finance institutions, increasingly undertake climate risk assessments, but often they're doing it at the behest of their regulators or their investors. And as a result, they tend to answer the questions, the risk assessments tend to answer the questions that the regulators have and the funders have, not the ones that the businesses have. And that's a pattern we're seeing all over the place. The risk assessments being made have to answer core fundamental issues of the business around where is the risk, how to address it, how to manage it for the institution, what clients need, what help they need from governments and funders to do that. So that all has to be grounded in the risk assessment. We need better instruments for risk transfer, risk management, risk finance, as we've already talked about. We have identified a number of models that we think are compelling, including the RAM project in Pakistan, including the Vision Fund Artist effort, which and these are very similar efforts that take a risk layering approach to things. Yeah. So in the case of RAM, this is a World Bank project with the State Bank of Pakistan for the microfinance industry specifically. And it has 3 tiers to it. One, which is based on reserves by the microfinance institutions themselves to deal with smaller risks. Second layer with a contingent line of credit so that when a bigger shock hits, financial institutions can access the liquidity and the capital they need, to Andrée's point earlier about having access to that funding. And then on top of that, a parametric insurance level for really major risks to unlock additional financing. We think that's a super compelling model. It's strikingly similar to what Vision Fund has done and built up over many years already for its own operations across the world. Yeah. So this is a single microfinance institution, or at the group level, organizing across 25 or 30 or so countries where they operate. Very similarly, based on reserves for small risks, contingent line of credit or contingent debt facility for slightly bigger risk, and then parametric insurance sits on top to help with a really bigger risk. So those are the kinds of models that we need to expand and make more accessible and more affordable for financial institutions if we are to expect inclusive finance institutions to be able to keep serving climate vulnerable clients, because they can't do it on their own. They will need help from the funder community, from the government community to do that. And the final piece I would call out is the product offering. Microfinance and inclusive finance generally is fairly conservative. There is less innovation on product than we would typically like to see in the space. And that just will no longer be viable. We need better ways to help clients build up their resilience to climate change, because that's ultimately the only way that financial institutions are going to be able to manage their own portfolio risk from climate change, is to help their clients manage their risk and adapt and grow more resilient to climate change. Yeah. And for that, we need better products.
I saw you were laughing then when you mentioned about product innovation.
Yeah, so. No, I mean, I didn't pay Peter to say that, but it was like a perfect segue because, I first of all, he knows I totally agree with that. We've basically, across the inclusive finance sector, we've been offering more or less the same products for 40 years. Part of that, honestly, particularly with the small and medium-sized financial inclusion organizations, is that the technology that they're running on is not very good tech. And it's pretty outdated, which makes it really complicated to do any kind of innovation. But there's also just the reality that, particularly under the commercial lens, there's not a lot of wiggle room for innovation and risk-taking. And so the sector as a whole hasn't driven innovation. So one of the things that we've done to try and address this, and Peter knows about it, is we actually set up a completely separate lab that's focused on research and product innovation, really looking at how do we run small pilots outside the context of the regulated institution that can be more risk-taking, that can be very focused on exactly these kinds of questions of, if we partner with a fintech, for example, that can provide our farmers with better access to information and recommendations about different fertilizers or irrigation techniques that they can use, can we improve the yields significantly enough to offset the cost of that? And so we're running a bunch of different pilots specifically focused on that, but we had to take it outside of the regular operations and really put a different team of people on it to allow that focus to happen. I'm excited to say that we've seen a lot of positive results already. We've only started doing this in the last couple of years. And then the idea, of course, is then once we've tested and proven that those product innovations are actually working, then they get layered back into the microfinance operations. And I'll go to the Vision Fund example, because I do think it is a fantastic example of ideally, again, how you build up those reserves as an institution in order to protect. And FINCA had that model actually some years ago. And it really is only as a consequence of, what happened in COVID that depleted the capital reserves to be able to do that. And now we're trying to build that back up again.
No, it's fascinating. I did read about the Vision Fund model. We had Selene, the Global Director for Insurance at Vision Fund, on the podcast in episode 4 this season. Andrée, I'm also very fascinated about this lab. So testing new pilots, innovations outside of the regular operations. But for such a global institution, for something that works, how do you embed this back in to country offices at such scale?
Yeah. So the mandate of the lab is that any project that it takes on has to have the potential to be sustainable and scalable. And so out of the gate, we're not going to do any kind of pilot program that we don't think is going to serve multiplicity of geographies. Okay. So the focus for us, and this I think is very much relates back to what Peter was talking about in terms of, the overall climate risk as well. In the last couple of years, FINCA has operations in 40 countries. We have financial services institutions that are focused on Africa and Eurasia. But for us, the strategy focus of the organization has really become, how do we solve Africa? That is where the climate impact is the most significant. It's where I will say the deviation in terms of economic well-being is the biggest. And so for us, it really is about how do we focus in on solving these challenges in Africa? And so our lab has really been doubling down on working with, again, third-party providers. And I think this is the other part of the innovation that's so important. Yep. Historically, for a very long time, I think that the funders would say, okay, we're going to give the money to this microfinance institution or other financial institution that's going to come up with the innovation because we know our customers the best, which is true. But what we've come to realize is that, yes, we know our customers the best, but we don't necessarily have the technology. We don't necessarily have that agile mindset that you need to really drive innovation. And so not only did we set up our own product innovation team in an agile frame, but we were like, we're going to partner with these fintechs that are outside that have these really amazing new technologies that they can layer on top of what we do. And then the good news is that one of the pilots that we've done already, which we started in Zambia, we're now preparing to roll that out across all of our subsidiaries in Africa. So
I think it's important to say as well that not everyone has to start from scratch and build an entire innovation lab. There are plenty of innovations that are out there in the wild already. CGAP has already identified a number of them, and we're going to be publishing that shortly on models that we think are really inherently compelling, exist in the wild, have been deployed by financial institutions, and we just all need to learn more about them and start testing them out. And not all of them are rocket science. One of my favorite examples is the contingent line of credit tested by BRAC in Bangladesh. So similar to how the contingent debt facility that we talked about earlier for financial institutions, this is a contingent line of credit for clients specifically linked to climate risk. So they went to their farmer clients. Those farmers are exposed to flood risk. They've been trying to sell insurance, but for various reasons that you are probably familiar with, selling microinsurance for flood risk is challenging. And so what they did was they established a new product, which was simply the promise of a loan if clients get flooded. So they go to the farmers at the start of the season and say, FYI, if you get flooded this season, we will extend you a loan. It'll be half the size of your current loan, same terms, same everything. And you don't need to sign up now, just letting you know, FYI, if you're flooded. And it's tied to a flood index. So it's a little akin to an index insurance product in that way, that there's a flood index and a trigger that's defined ahead of time. If the trigger is met, then the loan offer is made to the client, and the client can then decide whether or not they want to take up the loan. What's really interesting about that was the results, and these have been published. There was a guy at the University of Chicago who published this in peer-reviewed journals, so it's pretty reliable results. What it showed was that farmers cultivated almost 20% more land. They invested significantly more inputs into that land, and they got a 35% higher yield. as a result of it. The farmers that were not flooded, just because they had the confidence to invest more in the face of climate risk, just because they knew that they would have access to this line of credit if something happened. The people that were flooded, they didn't have the higher yields, obviously, but they just saw a smaller drop in consumption levels as a result of this. Very compelling results, the kind of behavioral change that you would hope to see from insurance, but sidestepping a lot of the demand side issues that we see with microinsurance, right? So it's a beautiful product, and it's very similar to what the financial institutions already know and the clients already know. It's the same loan, right? Yeah. The difference is the index portion, which is a little bit new to both clients and financial institutions, but otherwise it's a regular loan. So that's just one example of the kind of innovation that can be really powerful and doesn't have to be rocket science by any means.
So I agree with that. And I will just say that, one of the things that distinguishes, I think, these successes is that there was an appropriate education provided to the customers and that the staff was really well trained in how to do the explanations. We've seen progress on some of these dimensions before. I think like in Uganda, it was one of the first countries where microinsurance really grew really, really rapidly, but then there was a failure and it sort of fell off, right? But we know that you have to be able to explain to your customers the real value of whatever that intervention is. And that's not without cost. And so I think to Peter's point, more broadly, we all need to value the impact differently. But at the same time, we all recognize that all of the different layers of financing are under their own kind of pressure. And so there has to be clarity around the additional cost that's associated with that. I'm all for it. I don't want to sound like a negative Nelly at all, but there has to be, I think a transparent discourse around what that looks like. Yep. FINCA also has a number of areas where we have launched climate insurance that's attached to the loans that we're offering. And our own experience is just that it's not as easy a lift as you would think it is, because you have to do that explaining. We've also been experimenting for quite a long time. We started our own solar company in Uganda. Oh. I don't know if you've heard of it. It's relatively small compared to the initiatives that exist now in Africa, but it's called Bright Life. And so what we've been able to do through Bright Life is kind of come at it from the other end of the spectrum, which is, what are some of the solar products that we can inject into the system that are actually going to help our customers build their financial resilience even more. And at the same time, it's an offset to the climate risk because they're not reliant on the grid. So things like solar refrigerators and being able to have battery power that won't fail on them, that can allow them to light their business at night, for example.
I think what's important to stress here as well is that this is not all about damage control and figuring out how to do more with less. There are positive business cases for a lot of these things, right? So the BRAC product, for instance, showed a higher return for clients who had access to this product. Yeah. The same goes for the recovery lending program. The Vision Fund has been operating really compelling, where they do exactly the opposite of what microfinance and financial institutions tend to do after a shock, right? Shock hits, most banks run for the hills. They focus on clawing back repayments from clients. And Vision Fund said, no, that's not the right approach. We need to figure out how to lean in and give our clients more capital when they need it. And they proved that it's better for the client and for the business. So I think that the help that the inclusive finance industry needs is to take that risk of finding those positive business and impact cases with the hope that many of them will be perfectly self-sustaining once you get that. But we need to prove it out in order for that to happen. And that's where the assistance from the funder community, the investor community, government is really important.
And can we give props to CGAP? Because really, I think we undervalue sometimes how important it is for all of us who are on the operation side to hear about those examples. Because when you're head down and you're just trying to get the business to go, you don't have as much time to look up and see, oh, here are all the different examples that are actually working really well. And you have been contributing to that positive momentum for a very long time.
I was going to talk about that because we've mentioned some really interesting positive innovations in terms of product and business models. Yeah. But if I was sitting in the position of a director of a small microfinance institution that operates in one country, as you mentioned, stuck in the operations of day-to-day business and serving their clients, number one is the awareness of those solutions. So you mentioned the CGAP report. I'm very interested to know when that's coming out, and perhaps we can update the show links of those listening once that does come out. But also, what are the other avenues that they can become aware? And this can be maybe translated and packaged into something that's an easier output rather than potentially a long report. I read a UN report 6 months ago that essentially said that very few people read reports, and that was in a report, right? So the way that we consume media is also changing. And second, Andrée, you rightly mentioned there is additional cost to this, whether it's in the consumer education or the technology providers. So for a small institution that may not have the capital to invest in that, looking at the donor outlook with many, let's be honest, the funding is really tough right now. Yeah. What would you say to them on this, both the awareness piece of understanding the innovations, but also how then to finance that integration?
Our paper is coming out in the next few weeks, and we will go into all the areas that we've discussed here, including the strategy, the risk assessment, the climate risk finance and management, and the product piece. So I encourage people in the next couple of weeks to keep an eye on cgap.org/climate.
Absolutely. And to answer the other part of that question in terms of how an MFI can understand some of these innovations that are happening in other regions, but how that can be translated to more of a local context. Andrée, what would you recommend?
I'm a glass half full person by nature. I think you have to be in our space. But, one of the upsides of the decline in development funding that we've seen is that there is a lot more collaboration and exchange that's taking place between institutions. And so I think that, to go back to what Peter said, you don't have to go it alone. You don't have to set up your own innovation lab. It just so happens that because FINCA has such a broad footprint, it makes sense for us in many ways to test within our own ecosystem. But we're actually working a lot with partners to tap into what they're doing. So we have a really strong collaboration with BRAC. We have a really strong collaboration with CARE. We have these exchanges that are taking place. And I think we have to build off of each other's know-how and success to pilot together, as opposed to trying to build something de novo inside our own institutions.
It's been great to have you both on the show today. We looked at Pakistan as one example where, inclusive financial institutions have to pull back because of the perceived risk. And it's quite a worrying sign for other markets around the world over the coming years. So for both of you, if you have, one piece of advice or a key takeaway for, number one, a funder, number two, a regulator, and number three, a leader in the microfinance institution, I'll let you decide which one you want to take in their respective countries, of what they should be doing now and focusing their time. What would you say?
I would say for all of those three, the central priority has to be to lean into climate change and really figure out what it means. Because if you don't, doing nothing, waiting to see what happens is not a winning strategy. It will only put you further into the corner over time. So the time to act is now, and to lean in proactively, not reactively, help to manage climate risk to the sector by supporting clients to adapt and grow resilient, not by abandoning your clients. That goes for funders, the microfinance institutions, and for the government players in this space.
We need to lean in. We're not abandoning clients. There needs to be a very transparent dialogue between all three of those agents that you were talking about around risk sizing and risk sharing. And I think that is, in the near term, sort of like the first thing that has to happen. Because what has happened in the past with some of these crises is that the risk sharing wasn't spelled out, and the institutions, I think, ended up bearing the brunt of the shock, which damaged our ability to actually achieve our financial inclusion goals. So here we are. We've got this ahead of us. We need to have that very clear-eyed look at, okay, if we want to expand into or continue to lend to these segments, how much could it cost? And how are we going to divvy that up?
Peter, Andrée, thanks so much for being on the show.
Thanks for having us.
Thanks, Jack.
Thanks. And that's a wrap. If you enjoyed this episode, please make sure to subscribe or follow Financial Inclusion Unlocked wherever you're listening, whether that's Apple Podcasts, Spotify, or any other podcast app. That way, you won't miss any of our remaining episodes we have coming your way in this season. You can also connect with us on LinkedIn. Just search for Financial Inclusion Unlocked to join the conversation. This podcast is produced by SIJ Media, and Series 2 is proudly sponsored by CGAP. For more information on their work, check out the website at cgap.org. That's cgap.org. I'm Jack Farron, and I'll see you next week.